You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time, once again, for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to choose from on said network, 15 to be precise, including many great archived episodes with interviews and guests and debates and all sorts of fun stuff here on this fine program, Volatility Views. Where can you find all of that goodness? Of course, the mothership, theoptionsinsider.com. Insider Radio Network tab will get you off to the races. Also on the call out there on the right-hand side. It's even in the players, literally 3 places you can do it right from the homepage right there. So we make it really easy for you. Of course, if you want to go straight to the audio on your device of choice, iTunes, TuneIn, Stitcher, those are the places to do that fun stuff. And however you listen, maybe even via our mobile app available for iOS, Android, and the Fire OS, however you guys tune in and listen, including those of you who can join us every Friday, noon Central, 1 p.m. Eastern, via Mixler. Unfortunately, we couldn't do it last week. I apologize. But we were off traveling, both Russell and I off in the hinterlands there of San Diego, rough environs to have to do a conference. But someone's got to do it. But we're back now, streaming live, Mixler, MIXLR. You can get the link via our Twitter, which is @options, or on StockTwits, @options as well. You'll notice those handles now the same. So it makes it even easier for you guys to find us on social media. Same link once you get it. It works every week. So join us there if you're available with your questions, your comments, your insights, your hilarity, whatever you want to share with us. We'd love to see you guys there. And however you listen, make sure you hit us up. Questions or comments. We have a bunch of them. We had a bunch last week. We got a bunch more this week. So we love to hear from you guys. And joining me on the old program today, let's see, Mr. Rhodes will be joining us, but he has been detained a little bit. Some corporate stuff going on behind the scenes, so he'll be back here momentarily. But in the meantime, we are joined by the greasiest of meatballs, Mr. Mark Sebastian. Mark, welcome back to the Volatility Views program.
Hey, great to be here. It's a beautiful day here in Chicago, isn't it? Just a beautiful day.
Yeah, it's not bad for October in Illinois, which is usually pretty chilly. But today, not so bad. All right, with the gang mostly assembled, Russell will be here in a few minutes. We're going to dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. We've been running around a lot of travel locally here, as well as it is a time, of course, for the big Futures Industry Association Expo, which is a fun time here in sunny Chicago this week. Not a lot on the vol table there, but if you're into the futures and indeed some of the options, some interesting stuff going on. Maybe we'll get to that in a little bit. But first, let me welcome on. I think he's finally ready. Mr. formerly of corner office fame. Now I believe he's out poolside in Las Vegas. Rough life that he leads, Mr. Russell Rhodes. Russell, welcome back to the Volatility Views program, sir.
I heard everything you guys were saying about me. I was listening and being all stealth because I'm such a stealth guy. I'm in Las Vegas, but I'm like in a basement somewhere. I don't even know if it's daytime or nighttime outside. I actually forgot where I was the other day. I'm at the Financial Management Association, which is the largest consortium or largest conference of academics every year. I got to have a really nice heated debate yesterday afternoon as to whether VIX leads SPX or SPX leads VIX. Between myself and an economist from the Federal Reserve. So I'm having fun and being intellectually stimulated in Las Vegas this week.
We had that debate on the show last week, courtesy of a listener. So what was the economist's counterpoint? What was he saying?
He's, I call him an economist. I think he's more like a researcher for the Federal Reserve Board, actually. He thinks that VIX leads SPX. I don't think either lead either, but we agreed to disagree.
Economists, they call it dismal science for a reason.
Yeah.
But, that is an interesting point, though. We do have some research about a similar topic. Maybe not who leads who, but how they correlate a little bit. Maybe we'll get to that a little bit later. Them writing it up on Barron's recently. We saw some research coming out. But before we get to that, let's break down kind of the week that was and indeed still is. Of course, we are streaming this live on Friday, October 21st. Hard to believe we're 3 weeks through October already. A year just flying by at an accelerated pace right here, noon, a little bit after noon central here. So right about midway through the session. And today, at least, pretty mild day on the old street. Most of the major indices fractionally up or down on the day. Slight bias to the downside, except for the NASDAQ up a little bit on the day. But other than that, nothing really lighting it up. A lot of people, I think, were expecting maybe post-debate, post-other things, a little bit more movement. Earnings season, of course, going on as well. Maybe expecting a little bit more Sturm und Drang in the old marketplace. And yesterday and today, it seems like that is not indeed the case. VIX Cash right now, right about 1369 or so. So actually looking pretty good. About only a couple of ticks away from my prediction from last week. So let's just freeze it right here, and let's see if my volatility views, my volatility crystal ball, I should say, prediction is doing well. I also let the listeners play along. So they'll be voting. If you guys are listening live, if you want to go vote over there at Options on Twitter, we got the poll at last. Just put it up. It's going to run until the end of the show, so you guys can also predict where you think VIX will close. Close in quotes by the end of the show here. And indeed, of course, unfortunately, Mark, you were not on last week. And so your ghost made a pretty outlandish pick for a crystal ball of 9.99. So I don't think your ghost's prediction will be coming to pass this week, unfortunately.
Might happen in November. You never know. I think, I've been fascinating. Russell, I'm going to say that you said neither leads neither. I would say that sometimes the S&P is the dog and sometimes VIX is the dog. There are some times where you can clearly get a feel that, hey, we might rally or we might sell off. I actually tell people kind of, you can't look at VIX in a vacuum or S&P in a vacuum, but you can sometimes get a feel for what's happening when the S&P isn't moving very much and VIX is, or the S&P is moving a lot and VIX isn't. That can tell you some different things are going on in the market based on kind of hedging activities, and I think that's where you might see some things out of VIX or S&P every now and again. For instance, we've got one thing I do think is a leading indicator is when we see the S&P and VIX both down. That to me is typically extreme. From my gut, tells me to go long the market. So those are just some. I don't think so. Really, I think the answer is they need each other. They're like a married couple. They need each other.
The VIX and SPX, they're lovebirds, eh?
Longo. We need each other.
Yes, very
M
much
squared. Along those same lines, back in the day, the two markets that kind of had a relationship that we all paid a lot of attention to were the S&P futures and S&P cash. And sometimes a move in the cash would spark a move in the futures, or sometimes a move in the futures would spark a move in the cash. And I think that you could use that same analogy with VIX and SPX, or at least with VIX and SPX options activity.
Yeah. I think it's the relationship that matters, not what VIX is doing or what S&P is doing. You can't just look at the VIX and say, oh, that's telling us something. You really need to look at both in context of each other to get information. That's always been my opinion.
I think maybe I've got a academic paper in my mind now. VIX and SPX, neither is in a vacuum. I like it.
I like it a lot.
Yeah. And now I'm having some weird flash to a Sterling Archer flashback about vacuums.
Yeah. So, I think an interesting thing to look at is really when the correlation breaks between the two, that is a leading indicator, in my opinion, as opposed to one versus the other. So I actually think it's the correlation of the two that really gives me information. And that's what the academic paper should be based on is when VIX underperforms or outperforms, what does that mean? And there's probably something there.
Speaking of correlation, since you guys are talking about it, we might as well address it now. I was going to save it for a little bit later in the show, but it ties right on in. There's a big paper out of the folks over there at Option Metrics, and David Hait, their CEO. He's been on the network. It's been a while, but he's been on the network in the past. And they've been blasting all of us included. We haven't had a chance to really dig into it yet, but the folks at Barron's ran with it. This new white paper they put out regarding exactly what we're talking about, kind of the correlation or perhaps lack thereof between the VIX and XPX. The kind of title of it is the premise of it is the VIX is known as the quote market's fair gauge, but does it really deserve that reputation? And this is according, of course, to David. He wrote this paper. He says in his research, he shows that 98.8%. So quite a bit of the variation of VIX comes down to a small set of variables, leaving a scant 1.2% of its daily movement to be influenced by market sentiment that's not already on display in the S&P 500. He said most of it appears to be correlated to, quote, extreme stock market events happening contemporaneously, that is, reflecting the present rather than predicting the future, which, as we all know, VIX is ostensibly supposed to be, 30 days out. He argues that in light of this, VIX is more of a, quote, measure of contemporaneous, SPX jump risk rather than a tool to forecast future volatility. He goes on with, there's so much here, I'll try to condense it. It says the value of the VIX index on any given day is mostly determined by its value on the previous day and other lagged periods, and the magnitude and direction of the change in the SPX index on the same day. Since an overwhelming portion of its daily variation is explainable by a contemporaneous, he really likes that word, measures, this would suggest that its value as a predictor of future volatility or as a, quote, fair gauge is severely overstated. Let's see here. Do the VIX strong correlation with jumps in the SPX? Futures based on the VIX index could be used as a hedge against bi-directional jump risk. He talks a little bit later about some of the VXX, some of the other things. We won't get into that, but still, interesting thought. This is kind of a corollary to what we were kind of talking about on the show last week, and what we were just talking about now here about kind of the relationship they're in. We've seen a lot of papers all over the place over the years on different aspects of this. What leads the dance? Your economist friend there clearly thinking the VIX leads the dance. David here saying that a lot of the actual interrelationship between the two may be a little bit overstated, and what it's predicting actually maybe is being misconstrued. I don't know, Mr. Rhodes, have you had a chance to look at this paper? I know you're kind of knee deep in academic research right now at that conference. Have you had a chance to see this? And what are your thoughts on this, saying that effectively only 1.2% of VIX's movement is actually from market sentiment, quote unquote?
Market sentiment gets led by what's happening in the S&P 500. It's the same thing across the board for any broad-based market index, with a couple of small exceptions. So you're basically basically you're taking two things that are kind of joined at the hip and saying one of them is the cause and the other one is not, when actually the one that you are saying is the cause of what's going on with SPX implied volatility is actually related to what you're saying doesn't influence what's going on with the VIX. So it's kind of, I can see how you can make an argument on either side of it. Maybe that's what makes the volatility market so fun. You have everybody that has positive and negative attitudes about different ways to trade these things. You've got different attitudes about what actually makes VIX do what it does. I just personally, from watching it now for over half a decade, it's a reaction to what's going on in the equity market. People's sentiment changes because of what they're seeing going on in the equity market. So is it price action or sentiment? Well, sentiment is driven by price action. So I don't think you can isolate one over the other like that.
Mark, what are your thoughts here on this? I think you and Russell are warring for background noise today, but Russell's at a conference. Let's see. What are your thoughts here? I mean, this is kind of a bit of an ongoing debate here of exactly how much of VIX's movement is driven by the S&P versus sentiment versus a lot of the other mix out there, tradable products, et cetera. What do you think here about this breakdown, 98.8% versus 1.2%?
I mean, I think that, with rare exception, it's movement. It's just the magnitude of the movement. So, for instance, it's not as clear. If the S&P is up 20 and the VIX is only up 40 cents, you're going to say, well, and VIX is only down 40 cents. Excuse me. You're going to say, well, the VIX is down because the S&P is up. But, that underperformance is because of market sentiment. So it's both. It would be my thought process.
Now let's get into, we like research, but let's get into what's actually trading this week. What we're seeing, what's been lighting it up, or perhaps not so much this week. We've been talking a lot, and Mark, we had a good conversation last week, Russell and I, regarding, it's kind of been this ongoing dance between the futures and the cash. We were kind of debating on recent shows when those two would finally come together, which would move more. I think we were all wrong in terms of which would move more, and also the speed that it happened. They got together pretty quick last week. It seemed like there was a lot of heat coming off of a variety of factors, macro, election, earnings, et cetera. This week, kind of trailing off a little bit. We got about, right now as we're talking, it's about a two-handle range between the cash and the Nova VIX futures out there, which are right around 1570 or so out there right now. VIX Cash, like we said, hovering around that 1370 or so level, maybe a little bit off of that now. So that said, it's been an interesting week to watch. I think a lot of us, myself included, were kind of surprised that post-debate, post-earnings and everything else, we didn't see a little bit more action, a little bit more maybe volatility actually coming off for the latter half of this week. Some people I've been talking to kind of postulating that maybe that's the market after this last debate kind of saying, you know what, Hillary's a done deal. Let's price it in. The Trump-ocalypse that a lot of our listeners voted for recently, saying that was going to drive VIX over 20. Maybe that one's kind of going the way of the dodo, given some of these recent performances. So maybe that's what's being priced in right now, but it is an interesting time. Mark, what are your thoughts here on what we've seen this week, the trends in vol kind of trending off towards the latter portion of the week? You think that's really is the market buying Hillary and selling Trump, or is something else at play out there?
Yeah, I mean, I think we're setting up for a rally next week or even this afternoon. We've really seen the S&P spinning its wheels and the VIX come off 2 points and the VIX futures get murdered. The market is unwinding risk, and clearly is set up for a rally. We've had such a tight range that when we do break out, algos are going to explode. And we could see a day where we're up 30 or 35 if futures can break 2143, which who knows when they'll be able to do that.
Yeah, it is somewhat challenging here. We don't like to get political too much here on the show, but sometimes it's kind of hard to divorce all things macro volatility from a huge macro event risk like an election. And like it or not, it is an event risk, and there is uncertainty there. So that's going to be priced into the market, and something like VIX is going to reflect this. So, we're not saying we endorse one or the other. We're just saying the market appears to be favoring one or the other in terms of which one they think is going to win, and they're pricing that in accordingly. But it seems like this kind of flashbacks of a couple of weeks ago when Hillary seemed like she was leading, and it seemed like it was kind of a done deal. Then all of a sudden, some recent polls come out, and Donald was closer than a lot of people maybe thought, and so it got a little bit more contentious. VIX kind of getting a little bit more juice now. Seems like that lead is widening again, and perhaps VIX taking it on the chin. Also, the earnings not exactly the huge vol driver yet, at least so far. That some people maybe were hoping for or expecting. We still got a ways to go in the cycle, but at least this first week, 100 names coming off this week, so it was a pretty big week, including today. But so far at least, earnings not a huge driver for all things volatility. That said, Mr. Rhodes, what are your thoughts here on the week that was from a volatility perspective?
Oh no, we talked about the paper already. I mean, we pretty much covered it. I was just digging out the link to it. It's basically where the economist is saying that VIX is the tail that's wagging the dog of the S&P 500, and he makes an interesting argument about it. He actually claims the thing that he and I really debated was. He claimed that it was much cheaper to get volatility exposure through VIX than through SPX, and he was citing the spreads, and he was citing the spread the spread between VIX option bids and offers and VIX futures bids and offers and SPX bids and offers. But he was comparing them like apples to apples without taking notional and other things into account. So. That's another thing that that people will pick up on if they take a look at the paper. And when Twitter starts working again, I'll try to tweet it out as well.
Yeah, it's kind of been a challenge. We're trying to run this poll throughout the show here, and Twitter keeps having issues and crashing. There's a huge, huge DNS attack out there, denial of service attack out there on hitting Twitter and Netflix and a lot of other big outlets. It seems mostly East Coast related, but that stuff always propagates throughout the rest of the world as well. So if you're having issues answering our poll, we understand. All right, yeah, and by the way, if you're interested in Russell's paper, it is called, not his paper, the one he's referring to, Price Dislocation and Price Discovery in the S&P 500 Options and VIX Derivatives Markets. It's by Yang Ho Park of the Federal Reserve Board. Came out December of last year. So we'll include a link to it in the show notes, or you can just search for it there yourself if you are so inclined. That said, Mr. Rhodes, you've been knee-deep in papers this week, but what's been catching your eye from a volatility perspective?
Well, Mark summed it up pretty well when you said that VIX got crushed and the futures got crushed as well. I've been watching and I'm jumping to the weeklies portion here because that's something I was paying close attention to as we survived the last debate.
Wait, if you're gonna do your weeklies, you're gonna preempt your music unless you want your music now.
Let's go past the music. We're already
all right. No music for you this week then. Listeners will be sad.
There, we're done. So, no, just along the lines with the weeklies, I've been looking at the November 9th futures and the November 16th futures. And November 16th futures are the standard November contract. Now, here's the thing: the polls close on the 8th, and we've got VIX AM settlement on the 9th. So, there's not a whole lot of open interest with the 9th. I think people are just totally avoiding that settlement because let's just say there's probably some overnight risk associated with the AM settled, especially the options. The futures will continue to trade up until early in the morning, but it'll be fascinating to watch that whole process as it plays out based on what happens with the election.
But I think, nobody's expecting a whole lot to happen in the markets between now and the election. The election, the impact seems to be being felt, or the setups seem to be using the November 16th and not the November 9th option contracts. So that's you just said that, like, the November contract was at a about 2 point premium to spot VIX. We've been saying 3+ for things going out that far for several weeks now. So, 2 is still significant, but we are most definitely starting to flatten.
Yeah, it was about 3.5 points out there for quite some time. So you're right. Comparatively, it is definitely a wee bit flatter, shall we say? But still, if you're going to be writing in with questions about the VIX futures, there you go. That's where it lands. Talking about the VIX options, Russell did his weekly rundown already. It wasn't overall the big mothership options. It wasn't the most active of weeks, which again maybe might come as a surprise to some people, given the fact that we did have some events going on this week. We had earnings, we had the debates, we had some other things going on. But that said, it didn't really accrete to huge volume week, as we are again. We're at about halfway through the session, a little bit more than that today. VIX Cash, VIX Options, doing about a little more than half of their ADV right now, about 338,000 contracts. ADV actually dropping off, kind of a reflection of how light volume has been of late. It's been around 600,000, a little bit north of that for the better part of the past 6 months or so, and now right around 536,000. So that reflects, again, we have had some light periods of late. This week also fairly light. Most of the trading days this week under the ADV, with the exception of the 18th, that was about 780,000. So decent volume on the 18th, maybe not that surprising. And then the rest of the week, kind of light. The big trade on that day, it wasn't a lot to parse this week, but on that one day when things were lighting it up, we saw about, of that 780,000, nearly 100,000, 90,000 coming in some massive Nove call love to the tune of the Nove 26s. They were lighting it up, paper gobbling up about 90,000 in two chunks, 50,000 and then 40,000 again later on, doing all of that again opening, because there's only about 40,000 contracts open on that strike. So someone coming in for a little bit of Nove upside and a little bit more reasonable strike than we've seen of late, where people tend to still aggregate into the 30 strike for whatever reason. That strike just captures mindshare across the board. Also seeing, we talked about VIX 1x2s before, seeing perhaps a bit of a VIX 1x3. Maybe someone saying, I like 1x2. Maybe 1x3 will be better. I'm not sure if that's the ratio way you want to go. This went up kind of printing exactly mid-market, so we haven't had a chance to kind of parse exactly how it went up, but it was the OC 1719 1x3, so 15,000 on the 17s by 45,000 on the 19s, and size open interest on both strikes. So could indeed be closing there. The prices are fairly anemic. These are going out this week. So these were probably closing on a lot of these, given the fact that they were so near term out there. But still, the ratio kind of fun to see. And also looks like perhaps we could have two verticals, or we could have indeed an iron condor going up out here in the DEIS realm. So a little bit longer term, it was the DEIS 13-14 put spread versus the 2021 call spread, going up 25,000 times, aka looks like a bit of an iron condor for a total of about 100,000 contracts. So in those three trades alone, there's 100,000 there, there's 60,000 there, and then nearly 100,000 again. So you're talking about 250,000 contracts just in those three trades on Monday alone. That almost eclipses the total volume we've seen in some of the other days the rest of the week. So not overall. I think overall not the most action-packed of weeks. And looking at what are the hot strikes in this relatively light open interest and light volume environment, the number one spot is pretty light. We've seen this number one VIX option usually can be up there in the 400,000 plus contract range. Today we're seeing, or this week I should say, we're seeing more in the in the 160,000 contract range for the number one spot. Just to give you some frame of reference, that's usually like number 10 on our list. So again, reflecting we're kind of in a light volume environment right now. It's the Nove 24s with about 162,000 contracts open. It's pretty much all Nove all the time here with a little bit of Dece and also all calls all the time pretty much with one put on the list. Number two, the Nove 18s, 157,000 contracts. Then the Nove 20s, 148,000 contracts. Down to number four, the Nove 28s with 144,000 contracts. Here they are at the 30 strike. You're always going to find it somewhere in the top 10. Here it comes in at number 5 with 143,000 contracts for the Nove 30s. Down again to the aforementioned Nove 26s. We said paper loved those. 135,000 of those open. A lot of those probably opening this week. Number 7, the Nove 25s. 118, about 119,000 there. Then back to, again, the 30s, rearing his ugly head twice on this list. The Dece 30s with 116,000 contracts. Down to number 9 to find the first put on the list. The Nove 17 puts for 113,000 contracts. So wrapping up the top 10, the Nove 21 calls, 111,000. I think it's been a while since we've seen anything on this list that light on the volume side. Usually got to be at least $150 or so to be on this list. So again, kind of showing not exactly lighting up the tape this week. A total of about 4.3 million open, 3.2 on the calls, and about 1.05 or so on the puts. So a little bit extra out there. Interesting stuff on this. Speaking of interesting, you guys sent in some interesting questions last week, so I want to give you a chance to do so again. Without further ado, let's keep on rolling right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options. or facebook.com/theoptionsinsider.
All right, everybody, welcome to the volatility voicemail. This is indeed the portion of the show where you guys take the reins and take us into all sorts of crazy and silly and unanticipated directions. Really quickly, like I said, it looks like Russell is correct, and the Twitterverse is having all sorts of issues because we posted that poll, and we're starting to see some responses coming in now that things seem to be restored, but still pretty light. But so far, at least, we asked you where's Crystal Ball. You guys play along with the crystal ball with us. Where is VIX going to quote-unquote close or be at the end of the show? We gave you a nice range of 13.5, 13.75, 13.25, 13.5, 13 to 13.25, or about 13.76 to about 14. And so far, at least, it seems to be about 13 to 13.25, actually, winning the poll with still pretty light volume coming in. We got a little bit of time left. If you are streaming live, head on over to @options and let your voice be heard. But so far, at least, it seems like our listeners are losing. at least the lion's share. All right, moving on to the questions. We've got a bunch here. Let's see. Let's go with this one first, because this kind of directly relates to what we were talking about on the show a couple of weeks ago. This comes from Avery. He's responding to another listener question. I love when the listeners respond to each other. He or she saying, I found the discussion and the point, he puts in quotes, made by ThinkTankTrading, who was the listener wrote in a couple weeks ago, extremely confusing. Is this really something to worry about, or, as Mark suggested, is it really a distinction without a difference? VXX erodes predictably. Does it really matter if it's caused by roll yield or stampeding elephants? Interesting question, Avery. This refers to, of course, that discussion/debate we had a couple weeks ago, I believe, regarding the true cause of the relatively predictable erosion we've seen out there in VXX. That product kind of predicts erodes, I should say, very predictably. We've often attributed that to roll yield and the factor of buying expensive longer-term vol, selling cheaper near-term vol. Depending on the contango, that's going to impact you badly or very badly, depending on how it sets up. Think Tank had an alternative suggestion, which was similar, with a little bit of a nuanced difference there. but it wasn't really. I think she's actually referring to me. I believe I said that it was kind of a distinction without a difference. And I think for the lion's share of the listeners out there, if you understand that it erodes, if you attribute it to roll yield, you're not really doing yourself a disservice at the end of the day. But there is a little bit perhaps more nuance to it than we have led on in the past. I don't know, Mark, do you have any thoughts on this? Does it really matter at the end of the day where that erosion comes from, as long as it's A, somewhat predictable, and B, you can kind of you can count on it in the long term?
Yeah, well, yes, you can count on it, but it's not as predictable and it's not as cut and dry as roll yield makes it out to be. And the idea of roll yield means it's something like a bond, and it's not. There's there's just so it's not hugely important, but I think understanding the difference is still key. I mean, if you're going to trade this, then you should understand how it works. That's I think my strong point that I would say.
Well, I'm with you on the roll yield. I've always hated that term. I've taken to using it because it's kind of the convention. I prefer roll risk, quite frankly, when it comes to things like VXX, because there is no yield. You're right. It's a negative yield, and getting into that discussion is deeply confusing for people. So I prefer the term roll risk. That implies the kind of erosion that we're talking about. That said, I know, Mr. Rhodes, you have some thoughts on this issue as well. What do you think on this? What actually causes this erosion? And the question here from Mr. or Mrs. Avery.
Well, the erosion happens because when you are long volatility, you tend to lose money over time. That's it. You'll get a couple of bounces and you'll make money off of volatility, but being consistently long volatility means that you are going to that you're basically paying up for insurance, and when you pay up for insurance, that you don't use it very often, and it just continues to take money out of your pocket, I guess, but you do get some peace of mind. And that's really how you should think about it. The why doesn't necessarily have to come into play. You don't really have to. You just know that being long volatility is it's a strategy that is going to pay off every once in a while, but more often than not, just grind lower. That term roll yield actually comes from the VXX prospectus. And it's kind of funny how they say that, they say in their prospectus that the portfolio may be harmed by rolling positions. That's where it comes from. Now, whether they quantified it or not, and keep in mind they wrote this thing up back before it actually started trading in 2009, so maybe they were making an assumption that it might get hurt by roll yield, or a negative roll yield, to use their words. That's where the belief comes from, because they said it, and that's where that awkward term comes from as well. I do agree that it's awkward.
Yeah, that sounds about right. That sounds like a euphemism you would find in a prospectus for a fund like that. That's something a prospectus would have, rather than an actual person who tries to get into the thoughts of negative roll yield and all the fun connotations there. Yeah, I'm with you, Bo. I think at the end of the day, I think particularly for a lot of the use cases of people that we've advocated, which is kind of put it in your kind of 401k, let it sit there and erode for a bit. If the day-to-day nuances of the roll or the erosion are perhaps not what you expected, over long term, you still probably do all right on that trade. So unless you're really getting in and out day to day, then in which case, yeah, you need to know all the nuances of it. But if you're doing the old Aramco set it and forget it, VXX puts in your 401k type trade or IRA, then yeah, this for you is kind of a distinction without a difference. Let's move on to speaking of distinctions. This is an interesting one. This comes from Tom. Tom from New York City. He says, "Love the vol views." Well, right back at you, Tom. We love you too. He goes on to say, been thinking about, everyone's got 1x2s on the brain here. Everyone's been thinking about that 1x2 call vertical in VIX. Would flipping the script also work? So instead of selling one and then buying two calls, which is the traditional 1x2 we've been talking about, listeners, he goes on to write, would you instead buy one at the money VIX put and then sell two out of the money VIX puts? You could capture a downside move in VIX without spending a lot. While you're short an extra VIX put, you wouldn't have the same worry of being short a VIX call because the downside risk of VIX is limited. Thanks, and hope you read my question, Tom from New York. Well, Tom, it's interesting. I think you kind of maybe answer your own question within your question, which is kind of interesting because you mentioned, the downside risk is kind of limited. That's kind of why I don't think this one is really that attractive to the lion's share of people. You remember, VIX is obviously very call heavy. Volatility, when VIX outperforms, it outperforms dramatically to the upside. Not so much really to the downside. So the number of people out there, lining up to trade and buy VIX puts is pretty small. We covered that on the show before. Whenever VIX puts get a lot of volume, it's worthy of note for us because it doesn't tend to happen very often. And then B, also, when you're talking about selling the two or just getting that call premium, the VIX calls obviously have a lot more premium than selling two out-of-the-money VIX puts. There's not a lot of put juice out there to make that worth your time. And again, you're looking to capture a quieter, less attractive move to the downside. And I guess if you're not worried about that out-of-the-money put, the extra out-of-the-money put leg, you could indeed do this. But yeah, I think there's a reason that we don't see a ton of 1x2s the other way on the put side. Just because it isn't that attractive of a prospect for a lot of people out there. I don't know. That said, I don't know, Mark. Maybe this is a new strategy for the Carmen Line Fund. What are you thinking about 1x2 ratio put spreads in VIX?
Maybe Carmen Line has one of those on right now.
Uh-oh. Did you write this message? Is this you? Are you Tom from New York?
No, I'm not Tom from New York, but we do have on the no 13 put 1x2 on for even money. Small, nothing big, but yeah, I think those are a great trade if you can set them up right.
Well, there you go. 1x2 put love for you, Tom, there. I didn't expect you to get a lot of that, but here you go. You got one. So the one guy out there trading it with you, so it's you and Tom from New York, Mark.
I mean, I know a lot of people do this trade. When VIX gets low, that is a really popular trade.
I think that's the distinction we have to make, is that it's obviously contextual to where VIX is, and in this region that trade is more attractive than it would be in some other area. It may sound counterintuitive. Some people, we talked about this on the show last week, in some of the regions where VIX is low, that's actually where selling it is kind of attractive, and where VIX is high, actually buying it is kind of attractive as well, because it tends to when it's going to outperform, it's in those times. That's counterintuitive, and we've gotten into that in the past on the show, and people get all up in arms whenever we talk about it. I don't really want to go down that road yet again, but still, it's an interesting thought process. I don't know, Mr. Rhodes, what do you think about this, about the other side of the 1x2, the VIX puts buying one, selling two, as opposed to selling one, buying two on the calls?
I think the skew would get it. I'm kind of toying around with the numbers while you guys were talking about it. And the way the skew just flattens out is you start to go lower on the put strikes. And then the other thing, the trade might have some issues around how wide the spread is between the VIX futures, which the VIX options are pricing themselves off of, and where spot VIX is. So it depends on how long you think you're going to hold this thing as well. I did also, because I think you guys know I've been a big advocate of taking long put positions over the last couple of days into expiration when we've got enough of a spread between the futures and cash. I did take a look at trying to maybe sell an out of the money put to lower the cost of that type of a trade. And it's rare that you get much for a VIX put that's below the cash index, much more than maybe a nickel or a dime. So I just think the skew and the price behavior of the puts when you start to get close to the 10 strike makes it's like a great idea, but in reality, I'm afraid that the market adjusts for some of the thinking that was in the question. Like you said, the question answered the question within the question.
Yeah, it's not. I mean, it's not. There's no layup there. They're not going to let you put on the 1x2 on the 12-11. But if you do them tightly defined, they can be a great fit with some other trades that might do. I like them, especially if you can get a credit, which can happen now and again. And they can be. I like them as a way of playing convergence. So with that 13.5, 13 that I've got on, basically I'm long kind of the right at the money and then short two of the next out of the money. And that convergence when the VIX is at 13 is so slow. that what can happen is that 13.5 just sits there, or that 13.5 actually gains a little value, and your out of the money puts just stop. They don't move. They're a dime 20, and the VIX future goes from 15 to 14. And meanwhile, the 13.5 might go from quarter 35 to 40, 50, and you're able to flip out 15 cents. Doesn't sound like a lot, but when you've got low commissions and when you look at kind of the risk-adjusted return, it's not a bad little trade. That being said, there are obviously trades that will yield a lot more than that type of trade, for sure.
Well, there you go, Tom. A little more love for your VIX put 1x2 than I thought. I lean more the other way, but Mr. Sebastian liking them. And again, it's all in the execution. As Russell alluded to, you're not going to get a lot of love for those out of the money puts, so be careful how you sell them. But if you can get a good fire off on the downside, it might be worth. Particularly as Mark said, particularly if you can do it for credit, then yeah, that's certainly a little bit more attractive. Interesting stuff. I like when you guys flip the script on us. We got time for, let's see, I think we have time for one more. Let's go to this one from maybe we got a Jonas brother writing in, the Jonas bro. I love these handles. He says, Russell, we'll leave you out of this just in case you know something and you let it slip by accident. I don't know if you do or not, but we'll leave you out of it to keep you safe. All right, we'll go. Mark and I will just instead pontificate wildly on this one. He asks, this is kind of timely in light of FIA this week, what does the SIBO acquisition of BATS mean for the future of spikes? The SPY, I like to call it SPY 9, their much ballyhooed proposed, that was their VIX product, that was going to use SPY instead of SPX. He goes on to write, is it dead? Also an update, please, on Valdex and VIX up, VIX down. Well, we talked with those guys on the show not long ago. They have done their rebalancing. I haven't had a chance to really check in and see how that's doing volume-wise since they kind of have tweaked the calculation. But maybe that's worth checking up with again in a little bit. I'm gonna maybe I'll table that unless Mark, you've been watching that one for a little bit. Maybe I'll dig into that and we'll have some numbers for next week. Valdex is a little easier. This is another one that's kind of a casualty of the acquisition and M&A in the exchange space. Valdex was, of course, coming out through the ISE, the International Securities Exchange. They, of course, got acquired earlier this year by NASDAQ, and it was already kind of languishing at ISE. I think the issue they had there was that they needed an underlying for it, and there was a debate whether it should be an ETF or a future and how that would work, and if it was a future, how could they launch it, and that seems to be kind of what, I wouldn't say killed, but put that product into limbo, and now that it's part of the NASDAQ empire, I have not heard any talk of that thing coming back to life. Maybe it's worth a question to them, but I haven't heard anything on that. The spikes, the SPY 9, call it what you will. That's a more interesting one. I think the joke when SIBO bought BATS, the initial joke was, okay, Spikes is dead. That's why they did it. They bought it to kill Spikes. But that's obviously silly. If they had a product that could accrete, it's a competitor on one hand, but also if it could generate some volume, they would own it. That's a good thing. And then B, it would probably accrete back into the mothership eventually too in VIX, so it would probably drive volume there. So maybe the initial knee-jerk, oh, they're going to kill it reaction is a little bit overblown. That said, it was a big industry conference time this week, so I was actually going around and actually asking some people about this week because it is an interesting topic. I know a lot of you guys are interested in this, and they even discussed it on the Exchange Leaders panel yesterday where the BATS guys kind of gave it a big no comment, and a lot of people I've talked to behind the scenes kind of similar to the point where I've been doing this long enough now that I can kind of read between the lines and see that a lot of the way they're leaning is that sounds like the Spikes is probably going to go the way of the dodo. That said, nothing's been confirmed, and maybe, who knows, maybe it will rear its ugly head again down the road. But for now, I don't think if you're out there gunning to trade this thing, first off, it never even got approved by the SEC, I don't believe, so it still was away from coming to fruition anyway. But that said, I would not expect to see this thing trading anytime soon. That said, I don't know, Mr. Mark, you're out there flirting around with the folks in the VIX pit on a regular basis. Maybe you're hearing something I'm not. And also, if you have any thoughts on these other VIX products, let us know.
That product was dead before it even started. They were going to get sued, and they would have been found infringing. And Volbex, haven't heard anything about. The only product that I've seen that actually has gotten any traction in the last few months or years has been the VMIN and VMAX that use the weeklies. The volume there, because VIX up and VIX down are done. They're officially no longer in business. The hubris of we can do this clearly didn't work. And the VMIN, VMAX guys, which is really just trying to be a more stable, better version of VXX, they're doing some volume, but still nothing crazy. The average volume has been like 10,000 shares a day. So nothing when compared to VXX. And this is despite, if you look at, VMIN on a chart, or VMAX, and you compare it to kind of the returns on VXX, it's kind of doing exactly the same thing. Maybe it did spike higher than VXX did on that little pop, but it also has lost a little more value. So, there's really nothing exciting out there. I saw, I'm not sure if the Volex guys are ever going to get anything off. I would love to see it, but I'm just not sure, especially, whether Box will be able to get anything going. Question, I am not even sure that Box is going to get approved to open another floor. I mean, here's how out of touch the SEC is. They actually, when Box wanted to open a floor, the SEC was like, well, why do you want to open a floor? I thought floors were going away. And if anything, floors are consolidating, because the only way to avoid getting run over by lightning quick algorithms is to slow things down so much that they can't get out in front of you. And how do you do that? Open outcry trading. And so, anyway, small little diatribe there. I don't think that, we're going to see very much soon that's going to be doing anything.
Yeah, that was kind of a theme. We actually touched on the option block yesterday. Definitely a theme of the FIA conference this week. When it comes to options, at least, the pits are back, baby. So, Mark, you and I need to dust off our jackets and our badges. Time to go back down, because the NASDAQ guys were here yesterday. They were talking up their Philly exchange. They're really doubling down on their floor presence. They have new locals, new walk-in brokers all the time. Box obviously opening a new floor. SIBO obviously still has some presence down there. So, PCOS, everyone forgets about the PCOS, but they're still going out there as well. So, in the options sense, and you're right, it is kind of a natural antidote to HFT. It's natural. It's slow. You can't HFT in a pit. It just doesn't happen. So that's also price improvement kind of works natively in open outcry, because some guy's going to come in and carp you, and that's kind of price improvement right there. So there's a lot of these functions that we've had to build in as mechanisms into the online world just work as a natural function of how the pit works. So people are kind of seem like they're coming back to that again, which is kind of interesting. Everything old is new again. All right, interesting stuff. Great questions. It's all the time we got for this episode, but keep those coming. We'll get to more next week. Meanwhile, it's time for us to keep on going to our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, buddy, welcome to the Crystal Ball. This is the portion where we had great plans for you guys to play along as well. It seems like the Twitter outage derailed all of that. So the handful of you who could actually get through to vote seems to be losing as of now. You guys were leaning. You guys were fading vol more aggressively than I was last week. I thought I was pretty aggressive at the. I picked. What did I pick? I picked about 13. Yeah, 13.5. Which actually is looking pretty good. Actually, the start of the show was almost exact. So another good point 6-point win for me. You guys were fading it even more aggressive. You guys are fading it at the 13 to a 13 and a quarter range. That was winning with a tie beyond that for 13 and a quarter, 13.5, and 13.5 at 13.75. Again, the Twitter outage seems to be wreaking havoc with that. So we'll get hopefully Twitter will get its act together for next week, and you guys can play along a little bit easier with the crystal ball. That said, we had some interesting picks. Russell was an aggressive buyer yet again of VIX. So he and I on opposite ends of the spectrum last week. He's coming in at a whopping 17. So I will, in his defense, earlier this week that was looking pretty good. But I had strength. I had the courage of my convictions. I knew that at the week's end, all of this would be broken out in the wash, and we'd be back around 13.5. Lo and behold, we're at about 13.64 right now. So as the show progresses, the 13.5 comes closer. And unfortunately, the ghost of Mr. Greasy Meatball not faring so well, coming in at a whopping 9.99. He was fading the vol even more than me last week, and not looking too good. So therefore, I am the winner. So I will pick what I want to do. I like going first, quite frankly, because I like to set it up and then let the rest of you guys kind of debate what you want to do. Because sometimes you guys come in and then you pick, and then it's kind of you pick my pick, and it's annoying. So I'm going to go first. All right, let's see. I've been winning pretty well with fading of late, taking the other side of Russell. So let's see. 13.66 is where we are right now. I picked about a 13.5 this week. I'm going to say, we do have elections getting closer to the 4, but not again next week. We have earnings, but earnings hasn't really amounted to a hill of beans in the last few quarters, and so far this quarter seems to be playing out the same way. But again, I don't see us fading too much more to the downside either. So I'm kind of liking my range. I'm going to give us a little bit of a tick. I'm going to say 13.75 for next week. So kind of in the range where we are this week. All right, that said, Mark, you lost by the most, so I'll let you go next. What are you feeling for VIX Cash this time next week?
What did you just say? You said
13.75.
13.75. I'm gonna go with 12.50.
Aggressive fading. I could see that. I was kind of thinking that way, but I wasn't feeling as hard as you, Mr. Rhodes. You're gonna say like 25, so just have at it, sir.
I think we're for a nasty rally next week.
$1. I'm going with $1. That's it.
So you're just gonna...
I'm doing Price is Right rules, and I'm saying $1.
But we're not. So that's
actually, I'm going to split between you two, and I'm going to do if I take 12.50 and 13.75, and I take the average of those, what do I get? 13.33333. That's
you get 13.1233. 125.
I want a number that continues on forever. I'm going with 13.33333.
All right.
So 13.33 ad infinitum. So kind of given.
Because in all honesty, I don't see anything that's going to change volatility over the next week.
So giving up on the Trump-apocalypse.
Putin's going to go crazy.
Yeah, this is the week. Next week, if you're fading vol with us, then that means next week we're going to be at a 25 because that's the one week you're not buying vol aggressively, which is.
I just bought a bunch of VIX calls.
Oh, so there you go. So yeah, you fade yourself, and that works. Maybe you talk it up. That's a good way for us to go. It is indeed time for us to go here on the old program. Unfortunately, there we go. Waiting for that hook to come back in. But before we go, one last time. Check back in with my cohorts here, my partners in crime on the old Volatility Views panel. See what they have cooking that may interest you. Let's start with you, Russell, out in conference land. What's cooking in the land of all things SIBO and live vol and everything else you guys have cooking on under the sun?
Well, I'm actually out here with Kevin Nichols from Live Vol, and he's being really coy about what's going to be in the next in the next version of Live Vol, which means I think there's still it's a work in progress. But we're supposed to see an upgrade sometime next month. I know they've got a November deadline for that one. We've got a couple more of our fall classes going on at CBOE. We've got a level 2 class next Thursday and Friday, and I've got I'm doing the Asian swing beginning in the middle of November and running into early December, and I'm actually going to do some VIX events. I know for sure in Hong Kong, maybe in Singapore, or I'm sorry, maybe in Shanghai. We're still trying to get that whole schedule together, but things are starting to wind down at the Options Institute this year.
Yeah, but it sounds like things are kind of winding up over there in Live Vol. They've been teasing this upgrade for a while. I'll have to get Kevin or maybe Kathy on to maybe give us a little bit of a precise tease into exactly what they're working on. I've been bugging them for some good mobile functionality for a while. Maybe that'll be in the new release. So we were coming into that last week at the conference. We couldn't really run it in a lot of our mobile devices without having to jump through some hoops. So that might be fun, or a lot of other stuff. They're talking about, of course, the data shop over there as well. Maybe upgrades to there and what kind of data you can get. So I'm looking forward to that. Check it out, livevol.com. 15 days free. Kick the tires for yourself. And Mr. Greasy Meatball, before we go, in addition to 1x2 put spreads, was cooking in the land of Carmen Line and the option pit.
Here there's the CFTC is considering a simple $5 million fine to John Corzine for basically fraudulently causing the bankruptcy of the eighth largest bankruptcy in history, and putting 3,000 people out of job. If that upsets you, you should let your congressman know, or your CFTC commissioner.
A little political plug there on the end of the show, or a regulatory plug. That was indeed, you're right, that was a hot topic at the FIA show this week as well. We don't typically get into that kind of stuff here on this program, but it is worthy of note if you are indeed outraged, as many people are in the business regarding that. That was kind of the beginning of a very dark period for a lot of the derivatives markets. I think Mark's right. Have at your congressman or senator or your regulators if you can track them down, and give them a piece of your mind. Unfortunately, that's all the pieces of the mind you're going to get from us this week. On behalf of Russell and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing. For the handful of you who could vote this week, congratulations. We'll get more of you in next week once Twitter figures out what the heck they're doing, as well as everyone who sent in questions. Keep those coming. We'd love to hear from you guys. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.